This week, some of the loudest voices at the Federal Reserve said they want to raise rates. The bond market did the opposite. It quietly pushed rates lower. When the microphone and the money disagree, follow the money. Here's what that means for you and your clients. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. This is your weekend update for July 17th, 2026. Let's start with the big picture. A few Fed members went on record this week saying they think the Fed should hike rates, and the reason is inflation. But when you look under the hood, most of the inflation pressure is coming from one place, and that is oil. A red line warning out of Iran had oil markets on edge, and traffic through the Strait of Hormuz slowed to a trickle. When oil worries flare up, bonds often catch what we call safe haven demand. Money moves into the safety of U.S. Treasuries, and that helped push yields down this week. So here is the honest question. If the inflation fear is really about oil, would raising rates bring oil prices down? It would not. What higher rates can do is slow the whole economy until demand falls. That's a heavy price to pay. The market seems to agree. The odds of a Fed rate hike at the July 29th meeting keep falling, and they now sit near 10%. So what does this mean for housing? The housing market is telling us it feels the weight of higher rates. Signed contracts on existing homes fell 5.4% in June from the month before, one of the weakest Junes on record. And that happened even as prices pushed to a new high. Builder confidence dropped to 34, which is a weak reading. And builders are responding the way you would expect. About 37% of them cut prices in July. The average cut was around 6%. And nearly 2 out of 3 are offering incentives to move homes. There is one twist worth knowing. New single-family supply is actually tight. Permits for single-family homes sit near their lowest level in about a year. So while demand is soft today, there is not a flood of new houses waiting in the wings. For your clients, that is a supply picture worth watching. Now here's the part the headlines miss. Underneath the oil noise, inflation is cooling. Shelter costs, which are the biggest piece of inflation, are finally softening. Rents on new leases are rising far slower than a year ago. Wage pressure is easing, and factories are reporting that prices they pay and the prices they charge are both coming down. The consumer is holding up with retail spending up slightly in June, though we are seeing some signs of stress, like families buying smaller amounts at the grocery store. Add it all up, and the quiet data is making the case for lower rates, not higher ones. Let's talk rates. Here are this week's national averages. The 30-year conventional, 6.68%. The 30-year jumbo, 6.84%. The 30-year FHA, 6.29%. And the 30-year VA is 6.30%. These are national averages from Mortgage News Daily, not an offer to lend. As for the 10-year Treasury, which drives mortgage rates, keep in mind the market is still open as we record this. The 10-year is sitting near 4.53% right now, down from 4.57% last week. That's a small but welcome move in the right direction. What about the road ahead? Right now, the 10-year is parked near 4.5%, which is close to a just right level. Think of it as boxed in, with a floor around 4.2% and a ceiling around 4.8%. Which line breaks first depends a lot on two wars in the headlines: Ukraine and Iran. If those conflicts cool down, bonds could rally and rates could ease. If they get worse, oil and rates could climb. It is a week to stay alert. Now let's get to the tools and articles we featured for you this week. You'll find these on the right side of the dashboard or below the video, depending on the device you're using. Number 1, bankruptcy stops hurting your scores after 2 years. These 7 moves rebuild it fast. Number 2, from broke on paper to approved on cash flow. No new income required. Number 3, new student loan rules could change your payment, your limits, and your credit. Here's the math. Selling your home without an agent costs the average seller $65,000 in California. Selling your home without an agent costs your average seller $65,000. In California, double it. There are more waiting for you on the dashboard as well. That second article points to something we want to highlight this week. We have a selection of loan programs for the person whose tax returns do not show the full picture of their ability to borrow and repay. Today, we're featuring the bank statement loan. Here's the simple idea. We look at the income you actually deposit before your excellent CPA or tax planner uses every legal deduction to lower your taxable income. For a business owner who looks broke on paper but runs a healthy cash flow, that can be the difference between a no and a yes. You can get the details at rsrlinks.com/bank statement. That's rsrlinks.com/bank statement. This is a good moment for the one line we live by. Strategy beats rate always. Before we look at next week, I want to put a tool in your hands called Debt Done Date. Here's how it works. Your clients enter all of their debts, and we show them several smart ways to pay everything off. We're talking the mortgage, auto loans, student loans, credit cards, and other unsecured debts. It gives them a clear finish line and a real plan to get there. Share it with a client at rsrlinks.com/DDD. That's rsrlinks.com/DDD. Let's look at next week. Wednesday brings the weekly mortgage application numbers. Thursday, we get jobless claims, which give us a fresh read on the job market. And Friday's the big one for housing with new home sales, building permits, and the S&P Global Business Survey. We'll break it all down for you next week. That is your weekend update. You can share this full update with a client at rsrlinks.com/weekend update. We appreciate you listening, and we'll speak to you again next week.